Our average price is down closer to 10%, but on isolated incidences, you can find on a comparable to comparable basis, things are down up to 15%. Seems to be a bit of a plateau at this point in time. It seems like the hemorrhaging has stopped. So so prices are lower, but they don't seem to be continuing to drop, certainly not at the levels that they were. Some investors starting to jump back in, say, hey, these numbers work for me, I'm going to buy. And then a lot of sellers are saying, pulling back and going, whoa, like I want 2 months ago's numbers. I don't have to sell right now. I can wait. And a lot of people seem to have this mentality that things might be back where they were in 6 months from now or a year from now. So any of these discretionary sellers that really have control over time, they're starting to make the decision on a weekly basis. Do I list now or do I wait? So there doesn't seem to be that panic to the gates, that run at the peak that was there, of that run of sellers. We're starting to see people be a lot more hesitant. Do I have to sell right now or can I wait?
Hello, YouTube. Welcome to the Canadian Real Estate Channel. I'm Andrew, your guest host for the month of May, and with me I have Mitch Cleary, Peterborough expert, realtor and investor, and a very knowledgeable person. And we're looking forward to seeing your presentation today. How is the Peterborough market doing? Just high level, like give us some feedback, your thoughts.
Totally. Seems to be mimicking most of the peripheral cities that are, mid-sized cities in Ontario. When you think of the Kitcheners, the Waterloos, the Kingstons, the Niagaras, it's a very similar story where you see, hey, from the peak end of February to early March to right now, we're down, depending on how you dissect things, our average price is down closer to 10%, but on isolated incidences, you can find on a comparable to comparable basis, things are down up to 15%. So it's significant in our market as many others, where you're seeing stuff that's in this, little secondary suite range and target for people. A lot of them have dropped, in ballpark $100,000. So,
wow. No, that's not to say, like, I think that general sentiment depends how you look at it. Like, prices are kind of holding strong in a reasonable capacity. It's just that the growth has stopped.
Right? Yeah.
So it's not like the market has just tanked. It's just simmered, like it's leveled out. Right?
So it's interesting because for a while there, it really did seem that there was no end in sight, or the momentum was so far in the downward direction that we didn't know where the new equilibrium was going to be. We're still not sure we found it exactly, but there's definitely seems to be a bit of a plateau at this point in time. It seems like the hemorrhaging has stopped. So so prices are lower, but they don't seem to be continuing to drop, certainly not at the levels that they were.
Yeah. Well, that's awesome. And I'm just going to take this minute to remind everybody, if you like what you see today, like us, comment. We love to hear your comments, and subscribe. And Mitch has been on this channel far longer than I have. And if you haven't done already, click the notification bell because you want to see him and every update. So without further ado, you want to get into your presentation?
Absolutely. First things first, we are going to be so lucky to have these beautiful slides today, because instead of just putting this presentation together myself, I got my wife to help me out. so we're in for a treat.
The real brains behind the operation.
That's basically it. She is a member of the team. So let's go through. We'll start high level here. At a glance, like we spoke about there, first point is the market stabilizing. We're going to go into that in a little bit more depth, talking about some 7-day and 30-day metrics that we're going to look at. Is cash flow returning? Quick answer is yes, and we're going to talk through some reasons why, and just look at. I've got one specific deal breakdown that we can jump into, super high level overview, and there's many properties like it coming around. So we're going to go back into how the numbers are starting to shake out with the way that prices have changed. Talk about future risk, because that's the biggest thing right now is, yes, cash flows here right now. And we really are looking at this, we're analyzing each investment you're going to make as its own individual business. Just like any business, you got to assess, what are my risks going forward? And we're going to take a little bit of the risk, look at, sort of the macro risks, and then our local risks here in terms of any of the investment strategies that anybody might want to employ. And then key questions to ask in June. So trying to leave people with some next action steps there, and some sort of ways to think to get ready to make a jump here. So
I'm looking forward to that last one. What's going to happen in June, right?
Totally.
June 1st could change the landscape entirely, right?
For sure. So hey, here's one to just to start off for everybody. We took the leap and booked some seminar space locally in town here. So for anybody who's interested, if you enjoy what you see here, if you've been thinking about getting out to Peterborough and you want to get face to face with the team, myself, Tamer, and Sean, and our admin, we're going to be putting on a presentation, basically breaking down in depth how to filter through secondary suite opportunities, how to analyze them. Specific areas of town that we like and that we don't like, kind of go, neighborhood blocks, a little bit of analysis there. And then we're going to be looking at, how Airbnbs are being viewed locally here, some of the rates of return, some of the rents. And then we're going to talk about mid-size and large multi. So 3 presentations in the morning. Then we're going to go view some properties, and we're going to get a network session together. So this is happening mid next month. If you're interested in joining in with us, let us know.
That's amazing.
Yeah, so we started.
I didn't realize you were a partner with Sean. He's actually in a mastermind group of mine.
Totally, yeah. We have many links out there, and Sean's fantastic. He's our buyer specialist, so to speak. So a lot of the folks that come in, would they come in through any channel? Normally, high level, me, Sean, and our admin Jordan are sort of orienting people about what their financing potential is, what their strategy is, and then setting them forward. And most times, boots on the ground, point of contact is Sean. And then when it comes to offer time, the whole team's sort of getting involved and making sure we think it's a good deal.
Right on.
So yeah, Sean's super competent, awesome, and he's going to be in one of the videos coming up here that we shot on site recently. So let's jump into it. 7-day review. I've been breaking down, I've been doing a podcast every week so far in 2022. And one thing that I found was super helpful because things have been so volatile and the change has been so rapid, both up and down. We used to be tracking things monthly, and I've been tracking it weekly, found it extremely helpful. There's been way more insights popping out at me that I never would have got if I only stayed with the monthly breakdown. So on the 7-day review, the thing that I've been following the most consistently and using it as a tracker is just the inventory change on a 7-day period, because for a long time it was clear that I've been really sort of focused on following the second derivative, so to speak, of inventory, not just the inventory itself and if it's going up, but if the rate at which it's going up is going up faster or going up slower. So basically, is the rate at which inventory is going up increasing or slowing down? So on the 7-day, we can see over the last 7 days, 88 new listings, 53 firm sales. That's 35 net new listings. And that number is down for the first time in the last few weeks when I've been grabbing this stat. As we got into April, towards the end of April, saw this thing really accelerate, where in any 7-day period, I was seeing numbers in the 40s and some in the 50s, that in a week we'd see, the new listings would overcome firm sales by a number closer to 50. 35 is similar to what it was earlier on in the year when we started to see inventory increase. But so that is to say that although inventory is still increasing, absolutely, when we go down, we look at the months of inventory. The stats for May haven't been officially published yet, but for the sake of this video, because we're so close to the end of the May, I went on and grabbed just a 30-day grab back on the stats. 119 firm sales and 139 new listings. So it's putting us at a months of inventory of about 1.17. And how does that stack up with the rest of the year? April was basically bang on 1 month of inventory, and March was 0.6. So the absolute number The absolute amount of inventory, relatively speaking, is increasing, but the rate at which it is increasing seems to be slowing down, indicating that potentially we're finding a sort of a new equilibrium for this days of months of inventory, or the absorption rates. So I won't go too far into explaining that, because I know people savvy on this channel are well familiar with those numbers. But this number right here is the highest one we've seen in 2022, and it's actually the highest one that we've seen in all of 2021. We never saw a number this high. So the amount of inventory on the market is the highest that it's been when we're looking at the city of Peterborough. But it seems like it's starting to taper off, and we'll get into a bit of the discussion about that as we move along here.
Just a brief question for those that might not be aware is like, what a balanced market, what would that inventory look like? Would it be 1 month is sort of?
Yeah. So for anybody now, I've gone pretty deep on this one before, because when I got into the business, I wanted to understand this, and you see it sort of regurgitated all the time that a balanced market, typically people will cite it between 4 and 6 months of inventory. Anecdotally, when you see this, that's not necessarily true, because I've seen markets with 6 months of inventory. When you look at West, when you look to Alberta, Edmonton, Red Deer, where 6 months of inventory, and it was an absolute buyer's market. Like where in 6 months of inventory, in order to be the one that takes the sale, when you have normally with that much inventory, there's many homes for sale that are identically similar to yours in terms of what they offer, and it's just a race to the bottom on price. If you want to move yours, you got to be less expensive, because they're a commodity at that point. There's so many for sale that they're so comparable. So I think to generalize it is 4 to 6 months. You'll see that a lot of places on the internet. Sometimes you'll see 3.5 to 5.5 months of inventory. So a far cry from what we're at right now. But what I found to be more true than just it as a static number is how quick it's changing in either direction. It's more to do with the rate of change, because that is more indicative of sentiment. Because when sentiment's the lowest, when consumer confidence is the worst, that's when when inventory is accelerating, that's when the buyers just pull right back. And it's the way that I've sort of framed this in my own mind that seems to be a very helpful parallel is, if you think of, imagine you're self-employed, or even if you're not, if you're employed by somebody and you have 6 months of income in the bank. So if you were to lose your job tomorrow, have a car accident, you name it, and you couldn't work, if you had 6 months of income, you have a relatively decent pad to figure everything out and continue to pay your bills. But if you only had 1 month of income, you're pretty much month to month, you're very much on the edge. But the difference is that if you looked at an individual who only had 6 months of income, but you found out they just got an inheritance, or they have just got signed a job in some capacity that was going to pay them triple what it used to, you'd view them differently. So it's not so much the static, like, do you have 6 months of inventory or do you have 1 month of inventory? So which direction are you going and how fast that means more.
Yeah, that makes, and that's a reason to track it, maybe on a bi-weekly basis and sort of monitor that metric pretty closely, right?
Totally. And not that obviously inventory and price is everything. We go into this a lot on this channel, is that obviously in some way every investment you buy is a function of the price you buy it at, but at the same time there is some relativity, because the more time that buyers sense it sitting on the sidelines, the more that our rents have been rising, at least locally in our market. So it's you sort of squat, you hold down one variable and then something else moves. So on to the next one there. When I look back on 30 days of average price, the prices are up just around 1%, but basically they've gone sideways. So 1% statistically, not even going to call it a significant enough move to really count it. But the average price in Peterborough at the end of May, or at the end of April, pardon me, was approximately $729,000. And when I went back and grabbed all of the sales in the last 30 days, so again, this is not the concrete May number. You're going to see a different number when May's been tabulated. This is me going back the last 30 days as we shoot this here. We're May 27th. So this is from a day or two ago's data. The average price was $735. So that's still down roughly 10% from the end of March numbers on average. When you go to the median number, it's even lower. It's around 700,000. So basically it's showing us that we had this really big drop, like we spoke about at the start, double digit numbers, low double digits in percentage terms. And it appears that it has started to stabilize now. There's some investors starting to jump back in, say, hey, these numbers work for me, I'm going to buy. And then a lot of sellers are saying, pulling back and going, whoa, like I want 2 months ago's numbers. I don't have to sell right now. I can wait. And a lot of people seem to have this mentality that things might be back where they were in 6 months from now or a year from now. So any of these discretionary sellers that really have control over time, they're starting to make the decision on a weekly basis. Do I list now or do I wait? So there doesn't seem to be that panic to the gates, that run at the peak that was there, of that run of sellers. We're starting to see people be a lot more hesitant. Do I have to sell right now or can I wait? So deal at a glance. I want to show you guys, this is basically an example, because what I want to talk about in regards to cash flow being back is that there was a period of time there where we weren't too excited about a lot of the opportunities out there, but it's starting to be back to the point where anybody with reasonable expectations of getting in the game here we're starting to find opportunities that are feasible. So just an example here, I pulled this off of House Sigma. This is a local property. I blanked out the address just because it's hard to keep up with all the rules of what you can and can't post in regards to this information. But nonetheless, here's a property that sold for $550. Raised bungalow, good north end neighborhood. It's a two up, two down, 2 bath, and we ran some real quick numbers on this one. We had some buyers that were interested in it. Not an overly large footprint, basement. In order to secondary suite this deal, looking at approximately $90,000 for the basement, approximately $30K upstairs, with the way that the stairwell opening laid out in terms of setting up that common area and fire rating and whatnot, and then some minimal updating to be done on the second floor. Running an approximate, we're putting a 6-month period in here. You might be 30 days getting permit ready by the time you hold the thing, and then nowadays trying to get a contractor in there in time and being lined up, realistically you'd love to see 4 months on this, but we put 6 months in. So we're including all expenses for your financing and your utilities during that time. Closing cost with land transfer tax and legal fees, approximately $8,500. Your down payment, total cash in on a deal like this, approximately $254,000. Monthly cash flow at a 3.5% interest rate, which is something we could talk about. Obviously, that's lower than the fixed rates, and it's higher than the variable rates, but arguably it's where the variable rates might settle out here now in the midterm. So we'll dive into that, I guess, a little bit towards the end. But putting in a 3.5% interest rate. So basically you're cash flowing approximately $640 a month on this with a 5% capital expenditures assumption. So it's roughly, when taking all of your cash in on this deal, including your down payment and your renovation costs, your holding costs during the renos, and whatnot, approximately 3% cash on cash on a year-over-year basis. So that's purely cash flow after all expenses on your cash. So not including any equity pay down or any upside on the appreciation. I wouldn't say that you could really expect this to appraise out at much more than the value that you got in. I don't think you're going backwards on any of the valuations, but a lot of people who are secondary suiting these things in the last couple of years, they could instantly go back and pull out 80K out of these things. And it's just too flat right now to bank on that. But I do.
That's exactly the times, and as investors, we need to learn to adapt to the situations. And there's still, as you're showing here, there's still value to be had and good investments to be had, but you just can't have the same expectations that you're going to burn out all of your money in the first 6 months and be laughing, right? And like you said, make sure to adjust the interest rate. If you've got a calculator that's still set to 2%, you're going to be in trouble.
Totally. And not to mention the conversation we've been having lately a lot with people, is that sometimes the best way to lock these things up is with private financing, and you're going to be looking more in the low 5s, and then you flip them over to A lenders once you've actually done all the work and you've got your premium tenants in there, and you can show a few months of that rent roll, the 1-year lease, and then it's you got an operating business at that point. It's a little bit easier to get some green lights. So realistically, if we're going to talk about that somebody in the first year, your numbers might look a little different than this if you're going to go in private. So on to the next one. Things to consider here, just some observations we've been making is that a lot of buyers have been sitting on the sidelines. I don't think, just because prices have dropped doesn't mean the housing crisis is solved. The game of musical chairs is still going on. There's too many people and not enough homes. So I think that for all of the time that we've seen buyers sit out, and we have tons of buyers right now just waiting. They still, their needs have not changed. They still need to get into this market, but they've been holding off, and the rents have really continued to rise here. So whether there's going to be a little bit of a call it like a YouTube effect, like back and forth, where all of a sudden now the price of the properties have dropped and the rents have increased because all the buyers are sitting on the sidelines. As they re-enter the market, do the rents drop? It's a risk factor to be considered because the rents are extremely high for historical standards in Peterborough right now, and it's something that you can get really phenomenal rents right now, but going forward you might want to book them in just a little bit lower because there is some risk there. At least I think it's very hard to quantify, but it's a thought.
Just on that topic, I'd like to throw something in there, is that my personal belief is that just because I can get 1,800 in whatever given market, my preference is to not run my numbers at the best case scenario, right?
How close do you like to be?
Yeah, like I let's be safe. Like, let's say that this doesn't attract the attention I think it's going to attract, and it only gets 1,600. Does it still work at that point? Okay, great. Then it's a good purchase. But if I'm so tight to the line, like I'm $50 is making or breaking my property. Same thing with interest rates. If you're doing your calculations and 1% interest rate change is going to make it a bad deal, is that even a good deal to begin with, right?
I agree. I would say a lot of people got to readjust their mindset because through the last couple of years, I had people who were doing those downgrades saying, hey, look, I know I could probably get 1,800. I'm only going to put in 1,600. And then based on what they thought they could pay for the deal, they'd miss out every time because so many other people were factoring in the appreciation into the life cycle of the, if you're going to look at it on an internal rate of return basis, or just, your start to finish payout. A lot of people were just really banking on breaking even, or even going backwards a few $100 a month just to hold it for a year and sell it. And so people who are running their numbers conservatively would all we would do is run around and lose months in a row because consistently people would be willing to pay more. But now that the growth expectations are going to be a lot flatter, I think that it is time to return back to that mentality. Yeah, absolutely.
It'll be, just hearing you speak, it makes me think about the next couple of years will be very interesting because there was a huge push for investment properties in the last couple of years, right? Like, what am I going to do with my pandemic time? I'll learn how to buy real estate.
Yep.
And the new investors into the market went crazy. And exactly what you're saying, I'm curious that the people that were banking on inflation and banking on increased rents and banking on that sort of high safety of growth, will we see another contributing factor in the next few years of those people that realize they can't actually sustain those properties? And are we going to see a flood of sales into the investment market?
Yeah, so that's an interesting point. It brings me to one of the last slides.
Okay, well, we'll hold off.
yeah, no, totally, because I totally agree. So future risks, I won't go too far into the macro stuff as much as I love it, because the only thing is it's not specific to Peterborough, and that's what people are here to learn about. Is obviously we're predicting another 0.5 point hike in the rates here. What the new equilibrium is going to be is going to be hard to say. I think right now the whole market, everybody out there is trying to adapt to what is the new cost of money going to be. And then once people feel comfortable that it's stable, then prices the market will stabilize. I think as long as this interest rate and the signaling from the bank is every rate meeting is like a big media event, I think there's going to be volatility in the market because there's so much uncertainty about what the future holds, right?
It's got to leave the news cycle before any.
Totally. So I think, I've been talking myself with a lot of people that are in this game and mortgage brokers that are highly involved. And And I think a lot of people are of the opinion that it's going to land closer to 3.5%. That's that's a safe, stable number that in a regular inflationary market is gonna keep the cost of goods and services somewhat in check, and it's not going to totally crush things. But so I think it's reasonable to think that we're going to land somewhere in there. Who knows? Maybe the variable rates at some point go above 4, but a lot of people are pointing to if we do that the economy's totally smoked. So it's probably not going to be it's not going to be as low as 2.5, but it's probably not going to be higher than 4, because otherwise, so we're pretty bound in these set parameters, or at least it seems, of what might happen. But once we finally know, and then the Bank of Canada signals, hey, no changes for 6 months, this is the new normal, I think then people will be like, okay, we can proceed. But of course, a lot of unknowns out there, a lot of risk, like global risks with the food shortages, and there could be shocks to again to the equity markets as the prospects of future economic growth globally continue to get downgraded. The more that people see like the unrest, the reverse of the globalization going on right now, a little bit of tightening on the trade, cost of everything going up, and people start to say, hey, like, I don't think returns on company XYZ are going to be as strong in 10 years as I thought they were, and more money out of crypto, more money out, there's so many risks in terms of like global financial hardships that could spill over into the liquidity in our markets and the lending. I think that's obviously that even if our market is stabilized here right now, it's just something to keep on the radar to make sure that you're weatherproofed against that a little bit.
You make an extremely good point, is that the more distractions there are, I mean, yes, a lot of people still need houses and that's a priority, but if they can sit where they're renting for the time being and say, like, you know what, food and gas and whatnot is more of a priority to me right now, and the uncertainty, so I'm just going to like stay a renter for a while. And I mean, that's going to affect things as well.
Totally. So it's just making sure that if you're going to make the jump in right now, that you can weather the worst case scenario. Like if things do go down further, do you have to sell in 2 years? Is it a flip? So I think that every time like discussing risk, you can't talk about risk without talking about timeline. So it matters what your plan for your project is, depending how much any of those risks are relevant to you. Here's one that I think is the biggest one coming down the pipes, is the domino effect of some missed closings. We got a few of them firsthand that we got front row seats to right now, unfortunately, where there's closing delays, and we have lots of friends in this business in our city and in others where you're starting to hear about it. Closing, these people aren't going to close, they're going to walk on their deposit. People who bought in the peak and appraisals aren't coming in at value, and they're having to come up with an extra, $80K cash to close. They decide, hey, I only had $30K in, I'm going to walk. What's the odds somebody's going to actually follow through with this lawsuit? And it's just an ugly, there's a real potential for, I think the contagion from a domino of missed closings can just go off like a nuke bomb. And it started, there's the closings that are in definitely in high risk status right now. And this conversation's happening all the time. So I think that this is something that people got to be aware of. To proceed intelligently. You don't want to have fear, because I don't know how it's all going to pan out. But nonetheless, to not acknowledge this is I would say would be an oversight. So lastly here, this is something that on a case-by-case basis, every person we talk to when we run a needs analysis come in, it's how much capital do you got? How much experience do you have? What's your timeline? And what's your risk tolerance? And all of the macro factors we talked about here, we can kind of impose them over the top of like, hey, what can we actually find you in this market? And how do the rates of return work to compensate for any of the risks? And then what's your long-term upside? So, these are all things we're going to look at. We can't cover in the generalizations in a video like this. That loops us back to the seminar. You can get all, easiest place to get me is typically my email, but you can hit me on any of the socials there, and we can fill you in on the information on that stuff. So in regards to what to be doing right now, I could probably jump out of the presentation there just to loop and wrap. is I think that right now is a great time to be getting like ready on deals, because there's deals out there that are feasible, that deals that didn't exist a year ago or even 6 months ago, in terms of how much income you can get out of this property and what you can buy it for. But I still think that it's a little bit too early to call a bottom. So I think this is a perfect time to get educated and keep running the numbers, because that little bungalow that we showed you for 550, there's more like it just starting to pop up all the time. And once we can get you through feeling comfortable with the neighborhoods in Peterborough, understanding the areas that are more have more upside long term, where you can potentially. I just had a great conversation the other day with one of the planners here in Peterborough, that they are moving towards legalizing. Now this is a 1-2 year thing, but they're moving towards legalizing not just secondary suites, but also accessory dwelling units, both on the same property. So essentially, Ontario wide, there's the pressure to have the 3 residential dwelling units on one property. So that means that you can only choose one or the other right now. You can build an accessory dwelling unit or a laneway house, or you can finish the basement. Normally it's much more feasible to finish the basement, but it's coming down the pipes where we're going to be able to look at these properties that have wide side yards, potential for a laneway home, and you're going to be able to do both. You're going to be able to do the basement and the laneway. And I think that it's time to come down, get through a bunch of these places, familiarize yourselves with the streets of Peterborough, what our economics are down here, how you like the tenant base, and how these numbers work for you, to see 1 or 2 of them, because things could stabilize with the interest rates stabilizing here, and we could see the market be back on its feet, and the deals that are here today could be gone. But then the same token, things could start to fall again based on the way that the global picture plays out. So I think that we're at a really good landing point right now to assess, okay, I can make money in the market right now, come in and decide, hey, is this for me right now? Do I want to jump on it ASAP in case things go back up, or do I think that they're going to go back down? How far do I let them go before I green light it? And it's such a good frame of reference to get going. I think we can bring people down to the city right now, show them things they're going to be happy with, and you know, if they want to get their money to work for them, yeah, I think that the next 3 months are going to be a great time here.
Yeah, for sure. And something you were saying made me think, you know, the deals that are on the MLS now, like you made a really good point that somebody who might have stopped looking on the MLS because of tired of all the bidding wars and this and that, from everywhere that I'm hearing, you know, bidding wars, I wouldn't call them wars, more like scuffles with, you know.
That's it.
Right?
That's it. It's like a wrestling match where nobody's actually, you know,
yeah, maybe like 1 to 5 maybe people bidding on a property.
Yep.
I'm also seeing that. Personally, I'd think like days on market has been a useless metric for some time, because literally everything's an offers by date, so everything sells in, you know, 7 days.
Mm-hmm.
But now you can actually look at the days on market of a listing and be like, well, wait a minute, we're starting to see 2 weeks, we're starting to see 3 weeks, and that gives, as a buyer, that starts to give you a little bit of power, right? Depending on the seller's situation. So that's another reason to start looking at things a little bit differently. I think conditions, you might see people putting more safety out conditions on things. So yeah, it's kind of, I mean, everyone's like, oh no, the market's crashing, this and that. It's like, man, if things could return to 2019, where the market was predictable, manageable, I can put exit clauses, I can like actually read the metrics and see a path and see a strategy that I, as a buyer, can utilize. Like, oh, you know, Mr. and Mrs. Seller, your property's been on for 21 days. Like, you must be getting desperate. Can I give it a lower offer? You know, like, this is stuff we haven't seen in years, right?
Totally. Yeah.
Is it really a bad thing? I don't know. Like,
no, I think it's much healthier. I agree. It's been the situation for the last 2 years where there was a big risk in jumping in, but there was a big risk in sitting on the sidelines as well, because for everybody who sat out, they watched those who jumped in make hundreds of thousands, and their relative wealth decrease compared to everybody else who jumped in. So whereas now it's going to be a little bit more, take your time, pick your battle. Don't expect to get rich overnight, but yes, you can have your life savings do something tangible for you, you know. So a bit of a different approach, I think, for sure, than that. A lot of those burst stories. I don't know if we're going to keep seeing the type of numbers put up in the next couple of years that we have in the years prior. So it's going to be a shift in mentality. And I think people are going to have to get better at raising money outside of the conventional means to get these deals when the banks don't love them as much, or the banks aren't as excited about lending money out there. And I think, coming with a plan that's set to scale from the start is going to be important, because when we're not every mistake is just getting papered over by massive gains. I think you got to be a little bit more smart from the outset. How many properties do I want? Do I only want 3? Is that the max I want to own, or do I want to try and have 10? How am I going to get there? Can I do a short term, or is my lender not going to like that? All those types of questions.
Well, and your strategy should certainly be different if you want 3 or 10. Like that's a very different game to be playing right off the get-go. Mm-hmm. But in the interest of riffing on an idea, here's one for you. So you mentioned about like people that got in the last couple of years. They saw extreme gains. So say it went from $200,000 in equity to $500,000, and now what we're seeing is maybe it dropped down to like 450 or 400. Mm-hmm. So they're still up 200,000, right? So everyone's still up that was in. So with the leveling off of the market, and here's where I don't know if this is a commonly agreed upon thing, but this is my idea. I came up with it. In the last couple of years, the entire country has experienced this crazy growth, and it's unprecedented. But literally, the entire country. Mm-hmm. Tiny little towns with 7,000 people have, doubled house prices. Mm-hmm. I was around in Toronto in 2017 and early 2018 when there was a very specific bubble around Toronto where the same thing happened. Prices went, like my house doubled in price in like 2 years. Mm-hmm. And what happened was the Fed put out stoppage measures, okay, let's hike the interest rates, let's put in the stress test, let's cut the foreign buyers, and they did all these things, and it worked. It stalled the market. Prices dropped very quickly overnight, like we've seen in the last month, like the significant reduction, and everybody stopped buying, and okay, the market's fixed. Good. Okay, we're okay. And I was joking about the news cycle because I think it was maybe 3 months, 6 months at the most before everybody just went back and started buying again. Mm-hmm. Literally so I guess my question is what we're seeing right now, this rapid drop, stabilization, everyone's like, the number of times I've heard people say, I want to see what happens on June 1st announcement. It's like the world either stops or keeps going after that, right? Mm-hmm. And my prediction is that because the underlying reasons for the extreme growth over the last couple of years, like the limited housing and the need, like it's a supply and demand issue, my prediction is that within the next 6 months, we will just go back to maybe not crazy 20, 30 offers on a property, 200,000 over asking, but we're basically going to go back to some sort of will start going.
Yeah. I do tend to think that the yo-yo here, I don't think it's going to be like an 80s crash where you're 10 years to get back up to the peak prices, because people are still, I think the housing, the supply and demand fundamentals, like you said, the amount of new immigration versus the new units coming online, it still doesn't add up. Certainly not in our town of Peterborough. Mm-hmm. So I tend to agree with you on that. I think that once the worst of the pessimism has made its way through the system, that then the reality sets back in that, hey, we don't have enough houses, and then everybody carries on, at a slower growth rate because there's just not as much money to swish slosh around when the rates are at a new permanently higher level.
Yeah, and people probably won't be as aggressive as they were before because it's that feeding frenzy, the FOMO that really gets things going, right? So. Yep. But totally. I wanted to just to end off, maybe bring it back to Peterborough because we got off on a bit of a national level there. And I know Peterborough has a lot of relatively recent improvements or infrastructural changes that have a significant impact on the future of the city. And I don't know how long it's been, but I think the 407 was extended out that way, correct?
Yes. So
that's changed things probably huge for the city, right?
It definitely changed it to some degree, for sure. We got a regional hospital here. There's an airport that's got set to have a ton of growth. And I think that Peterborough just has so much to offer in the way of its amenities that as soon as people could work mobile, and a lot of the people that were still helping move here, they have mobile work, and their jobs are based in the GTA, with marketing firms, accounting firms, you name it. Just the amount of Canada as a whole right now that's knowledge work, and the amount of millennials coming through the systems that are knowledge workers, and they're really portable. It doesn't necessarily mean that they want to pack up and move to Nova Scotia if they have family in Ontario, but they want to find the cheapest place that they still deem to be a livable city here. So that's really been one of Peterborough's calling cards over the last couple of years, is that we have everything that they want in terms of, we got Little Lake right in the center of the town. We got the rivers systems. We got walking trails. We got, live music at downtown bars. Our industrial economics need some improvement, but largely we just continue to grow from baby boomers moving out of the GTA, finally taking their time to leave the city and come to where there's lakes in close proximity, lots of golf courses, massive hospital, and then millennials that are knowledge based, working from a laptop, and only have to be in the city 3 days a week, if at all, and they're totally open to going Kingston, Niagara, Windsor. It doesn't matter. They're sort of looking at all the parts and pieces, and a lot of people seem to choose Peterborough as young couples that want to move here and start a family.
Yeah, and I think that as maybe in an investor focused mindset too, like there is a future, a very prosperous looking future for Peterborough, and as you said, it's a beautiful city. And I love that river in the center, and I've been there a few times and was surprised that it's sort of a very walkable downtown. And there's still opportunities. I know that there's a few neighborhoods, like any city, where there's opportunities for cheaper bargain houses. And then, you've always had the strength of the university. So there's a lot of fundamentals that stay. And as you said, with the accessibility of, now you've got two highways going to it. The future, it opens a lot of doors, right?
Totally.
Even though it seems, I'd say that Peterborough as a whole is sort of in your average affordability range.
Mm-hmm.
Right? It's not out of reach, but it's still within first-time buyers' reach. That there's a lot of room for the market to go up, and an investment today, like, what do you think 5-10 years down the road could be very lucrative, right?
Yeah, I agree. As much as our prices have jumped compared to what we're used to, when you look at it versus Ontario as a whole, they are still affordable, flat out, for the amount of land you can get and for the what you can get out here. What the city has to offer, I totally agree. With a long-term view, the more people become mobilized and more that continues, I think that Peterborough does look pretty good in the long-term picture.
Yeah, for sure. And I always think back to what have I heard the most about recently?
Yeah.
And a year or so ago, it was Windsor. And then now I'm hearing Sudbury, and a little bit of like East Coast. Mm-hmm. But Peterborough is one of those cities that sort of popped up sort of maybe a year and a half ago. People were like, oh, that's a great place, sort of an untapped market that wasn't on the forefront of everyone, like the tip of the tongue, right? But it's increasingly becoming more tip of the tongue. And
totally.
The more people talk about it, that's a good thing if you get in.
Now I know what you mean. Yeah.
Before it becomes a regular conversation, right?
Yep.
So it's like, look where there's sort of like a swirl around Southern Ontario, and it's like it stops and hovers over certain places, right? Well, you want to get in when the chatter is just starting, right?
Exactly. Not once it's peaked and it's that frenzy stage. So I couldn't agree more. So that is a good thing to loop back to, I guess, before we wrap, is that, you know, if anybody is up to taking a Wednesday off in a few weeks from now and they want to come down and get face to face and actually tour some properties, you know, reach out. We got limited amount of seats, and obviously we got a lot of our sort of people that have already sort of reached out to us that we're going to fill in there, but we do still have some spots, so we'd love to.
Yeah, limited spots available.
No, well, we actually do have, you know, we didn't want to go big on the first one. There's only like 30 spots in the room, and then of course we have some of our own you know, friends that are looking to get into investing. And I mean, you take 30 seats, there's 5 of us on the team. There's not a lot of, so there's only so many spots for people that are sort of just coming in cold off of the internet right now. So but nice, we do have a few
too, right?
Totally, exactly.
Yeah. Well, that's awesome. I mean, I have had a blast talking to you. I really appreciate your time. What is
Andrew. Yeah.
What's the if you could choose one form of contact, what would it be?
Email's the best. Yeah, because it's not just me monitoring it. So if I'm out on appointments and it's a busy day, somebody's still gonna get back to you.
Right, and of course we'll have all of your contact information in the notes,
yep,
and all of my contact information in the notes, which if you want to get in touch with me, Andrew Cox on Facebook and on Andrew Cox REI everywhere else. Instagram is great, so please follow us both and follow this channel. Again, reminder, like, subscribe, click the notification and all that good stuff, and comments. We love to hear your comments, and it's a great way to get some conversation going. So thanks again, Mitch. Look forward to
thank you, Andrew. Thank you very much.
Bye-bye, YouTube.